This couple was about to hand the IRS $170,000 over the next 20 years of their retirement, and it was completely avoidable. If you're retired or approaching it, there's a good chance you're making that same mistake, not from doing something wrong, but because you're doing nothing at all. I'm Eric, financial planner at Allwealth Planning, and in this video, using an example couple, I'll show you the exact withdrawal sequence they use to legally pay zero federal tax on $107,000 of retirement income. Ryan and Kate decided to retire at 60. They have $1 million nest egg split across an IRA, a taxable brokerage, and a Roth. Their situation is probably closer to yours than you think. They were worried that they couldn't maintain their lifestyle in retirement. After crunching the numbers, we showed them that if they didn't optimize their tax strategy, they'd have over an $8,000 black hole in federal taxes this year alone. Over 20 years, that's $170,000 handed to the IRS that could have been spent on enjoying the life they'd been building towards. The reason most retirees overpay isn't because they're spending too much. It's because they're pulling from the wrong account at the wrong time. To show you why that matters, think of your retirement income like packing a suitcase to take a trip abroad. The airline, we'll call them IRS Airways, has two rules that every passenger needs to know before they pack. Every passenger gets a carry-on allowance. That's your standard deduction. It's $32,200 for a married couple filing jointly in 2026, or $35,500 if both spouses are 65 or older. Whatever you pack in these three cancels out the first $32,200 of taxable income before the IRS even starts counting. And if you're over age 65, your carry-on allowance is slightly higher, which actually works in your favor. The checked bag, however, has a strict weight limit of $98,900. But here's the thing. This bag is only for one type of income, your long-term investment gains from your taxable brokerage. Keep those gains under $98,900, and the whole bag clears the scale with no federal tax owed. So in Ryan and Kate's case, they have $107,000 to fund their year in retirement. To get there without owing federal income tax, they have to be very careful about how they pack. Step 1. They pull $32,200 from their traditional IRA. Now, IRA money is normally the heaviest kind of weight in the tax code. Ordinary income, taxed at the highest rates. But because the first $32,200 of weight sits in that carry-on allowance, this withdrawal never even hits the scale. They've taken $32,200 out of the bank, and the IRS doesn't charge a fee. Step 2. They need $74,800 more for their lifestyle, so they pull it from their brokerage. This is the long-term capital gains, the one kind of weight the tax code treats lightly. Unlike IRA money, the tax code has a special rate for this, 0%, as long as the total taxable income stays under $98,900. Ryan and Kate's bag hits the scale at $74,800, well under the cap. The whole bag clears the scale. Federal tax owed is zero. But here's how Ryan and Kate took it a step further. Sometimes even a $0 federal tax bill isn't quite enough for the life they want to live. That's when they reach into their secret compartment, the Roth IRA. This is the bag IRS Airways doesn't even have a policy for. Qualified Roth distributions aren't included in taxable income. They add zero weight to the scale, trigger no federal income tax, and no matter how much Ryan and Kate pull from it, it doesn't move the needle. When they need an extra $10,000 for a big trip, they zip it open and walk straight through the gate. The Roth doesn't just lower the tax bill, it's completely invisible to the system. So the order is simple. IRA first, taxable brokerage second, Roth third. That sequence may be the difference to give yourself the peace of mind you need to retire. For Ryan and Kate, here's what that looked like. Total income across all sources, $107,000. Total federal income tax owed, zero. But look at what happens if they pack in the wrong order. If Ryan and Kate took that same $107,000 entirely from their traditional IRA, stuffing all that ordinary heavy income into the checked bag instead of splitting it correctly, IRS Airways hits them with every fee in the book. Ordinary IRA distributions are taxed at marginal income tax rates, not the preferential capital gains rates. The result, approximately $8,480 in federal income tax owed this year alone. It's the same $107,000, but the withdrawal order completely changes how much of your retirement income you actually keep. Now, whether you have a pension, Social Security, a 401k instead of an IRA, the numbers may look different, but the same logic applies. If you want to see what this could look like in your specific situation, book a call via the link below. Now, if the stock market dropped 15% tomorrow, you'd be worried. But handing over a significant sum of money to the IRS across the course of your retirement is the exact same thing. It's a self-inflicted lifestyle cut that is entirely manageable. The only difference is that the IRS takes it quietly 1 year at a time. And most retirees don't even know it could be planned for. But here's the scary part. Even if you pack your suitcase perfectly, the IRS has 2 traps set for later, waiting for you at the gate that your ticket never even warned you about. If you don't defuse these before you hit age 70, the sequence I just showed you won't matter. The first is the RMD time bomb. At age 75, the government takes over the packing for you. They force you to withdraw from your traditional IRA, whether you need the money or not. If Ryan and Kate leave their $500,000 IRA untouched for 15 years, assuming a 7% average annual return, it could grow to approximately $1.4 million. At that point, the IRS forces out $75,000 or more every year. They've effectively hijacked your suitcase and started stuffing it with heavy income that pushes you into higher brackets with no way out. This approach may help shift how and when income is taxed, which can provide additional flexibility in managing future tax obligations and cash flow. And here's the kicker on Social Security. Once it turns on at age 70, up to 85% of your benefit becomes taxable, depending on the rest of your income. The bigger your IRA balance when Social Security starts, the more of your benefit the IRS quietly takes back. So diffusing the IRA bomb early doesn't just defend your portfolio, it defends your Social Security check too. Now, the second is the widow's penalty. When one spouse passes, the survivor is forced to file as single. Suddenly, your tax brackets shrink by nearly 50%. The same $107,000 of income that used to clear the scale with no federal tax owed is now triggering massive tax bills. At Allwealth Planning, we see this all the time. Planning together now makes sure that if the worst happens, the surviving spouse isn't left fighting the IRS alone. Those are the 2 threats you have to defend against. But I want to leave you with one offensive move. This is something most retirees completely miss, and it's the closest thing to a first-class upgrade the tax code will ever give you, and that's the step-up gift. While operating within the 0% capital gains threshold, Ryan and Kate may choose to sell and reinvest their assets in their brokerage account. Think of your brokerage account like a house. The basis is what you paid for it. The gain is how much it went up. Usually, the IRS waits until you sell to take a cut of that growth. Recognizing gains now allows those gains to be reflected in the investment's cost basis. Over time, a higher cost basis may reduce future taxable gains depending on applicable tax rates and individual circumstances. What Ryan and Kate's story proves is that retirement isn't about how much you make, it's about how much you keep. They didn't need a 50-page binder to feel safe, they just needed to know which lever to pull first. The truth is, the more time you have before age 75, the bigger the win. But whether you have a 15-year runway or a 5-year window, the goal is the same: taking control of the math before the rules change on you. That window is worth $170,000 to Ryan and Kate, but it's worth an enormous amount of safety to anyone who uses it. But whether we speak or not, understand that this is the shift retirement actually requires. For 30 years, your safety came from seeing the total balance go up. Now it comes from how much of that balance you defend. Think of it as an increase to your retirement cash pile that finally gives you the permission to stop being the person who saves and start being the person who enjoys. When the numbers work this efficiently, you stop wondering if you have enough, and you start knowing you're in control. I'm Eric, a financial planner at Allwealth Planning, and we help hardworking savers retire with that confidence every day. Subscribe for more retirement guidance, and I'll see you in the next video.